The intervention was pretty much expected, but the downside on the Hong Kong dollar has been quite something.
Yeah, the selling pressure on the local currency, as you mentioned, has been something that we've seen for weeks now against this hawkish Fed, against rising treasury yields, the strong dollar story as well. You add to that. The domestic side of things here in Hong Kong hasn't been good either when you had growth slow down due to these COVID restrictions. So you add the hot CPI print from the U.S. overnight, and that certainly was the trigger that sent the Hong Kong dollar to 7.85. That is the weak end of its trading band, and essentially forcing the de facto central bank to step in to defend the peg, buying $1.6 billion of the local currency. That's essentially around 202 million US dollars. You take a look at the Hong Kong dollar now, we're still actually at around those levels. And DBS is saying, look, pressure for the Hong Kong dollar will remain as we continue to see rate hike bets being priced in when it comes to the US yields. If there's any kind of silver lining, perhaps the economy is on the mend here as well. After that 4% contraction in growth we saw in the first quarter here in Hong Kong, now that we have curbs loosening in May, that perhaps puts the economy back on track on a recovery and could provide some support for the Hong Kong dollar.
How much further can they continue to defend the peg if the Fed continues with its hike path this year?
It seems like they could continue to defend the peg, at least in the short term, Heidi, and we could see persistent sort of intervention for the weeks and months to come. But it's interesting, Bloomberg Intelligence's Stephen Chu saying it isn't quite a problem, the hawkish Fed, for the Hong Kong dollar for now. Yes, the trading band is a bit of a constraint for them. It doesn't give them that much wiggle room, and it will be tested in the next short term. But if you look at key measures of liquidity, for example, HIBOR, is only just about 0.2%. You look at the aggregate balance of the HKMA, that's still very positive as well. So you're not seeing that much signs of stress. In fact, the HKMA did say, tracking back to data in March, they're not seeing significant outflows just yet. So there may be something for the Hong Kong dollar bulls now. And maybe even Stephen Chu is saying you could see local interest rates here start to catch up or even surpass the U.S. rates at one point if the Fed has to really revert to monetary easing after its aggressive path. You also have Stock Connect inflows. You have listings here in Hong Kong that could provide some currency tailwinds in the medium term, according to BI. Of course, there's still those longer term questions, whether it's time to unpeg the Hong Kong dollar to the dollar. Is it time to repeg it to the renminbi, for example? I think those existential questions still remain the focus right now, too.